you, Marty. Greatly appreciate that. And, I was listening to Jeffrey very carefully when he was giving his presentation. And, some things that I've heard and have heard consistently among people here on our panel is, these are the early innings of a long recession, deflationary period, not since the 1930s. But the good news is we've got some very smart people who know how to make money even in these market conditions. And I think we want to focus on that. We want to talk about alpha strategies this afternoon or this morning. And with me today is of course, Cory Reeder, Chief Investment Officer of Omnia Capital. We have Tyson Halsey, who is also online with us. And we have Blake Singer of Amera Securities. So we've got three really great people that know a lot. So alpha strategies, we're going to define what that is. We're going to talk about what it means. We're going to identify different alpha strategies that are out there. We're going to talk about the sustainability of them, the concept of beta and how that relates to alpha strategies, use of technology, and how that really helps, track all this and makes it possible for the trading that people might want to do. So those are some of the things we're going to touch on this morning. My name is Mark Heil. I'm the institutional sales team with Pacific Premier Trust, a division of Pacific Premier Bank. We deal with self-directed IRAs and tax-efficient methods to invest into alternatives. So I'm looking forward to our conversation today. Working for a trust company that's owned by a bank means one thing. We have lots of lawyers. And they require me to read a little disclosure. So I'll do that very quickly. Information presented here is for educational purposes only and not intended as or be relied upon as tax, legal, investment, or other advice. Pacific Premier Trust performs the duties of a custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You are advised to consult your professional advisors for specific guidance regarding investments. Investments are not FDIC insured and are subject to the risk, including the loss of principal. And I'll just add on to that to the extent that I offer an opinion or something, it is my personal opinion and not of that of the bank. Marty, I see a note in here. You're saying my headphones are not working well?
Yeah, it's hard to hear. You're all garbled.
A little garbled.
I'm still a little.
Now you're muted.
Is this any better?
Yes.
Much better.
Okay, that's not good. All right, well, I'm looking forward to this. So for the next hour or so, we're going to have a discussion on this panel. I'm going to be having not just discussion, but debate on the topic of alpha strategies. We invite you to be part of the conversation. Yeah, when you join the conversation, tell us your name, your company, and your position or title, and ask the question as succinctly as possible if you could. We'd love to have your thoughts and insights on here. We'd like you to be part of it. We'd like it to be in real time, so don't wait for the end. As it comes up, Blake is my eyes and ears in San Francisco, so he will be waving his hand to me whenever there's somebody in the audience that needs to be participating or asking. If you're online, you can just type in a question and I will get to that and read it out to the group. So with that, I want to introduce our panel here. And I think I'm going to start with Cory. If you could just take a minute, introduce yourself, tell us a little bit about your background in Omnia Capital Management, if you would.
Oh, now frozen. Okay, there we go. So I'm originally from Australia. You might hear a slight accent in the voice. My background, you can't see it here on Zoom, but I am 7 feet tall, and I did play basketball professionally for 9 years prior to getting into the investment arena. And I've been a fund manager now for 17 years. Came up through Smith Barney, up through Morgan Stanley, managing stuff there, and then left out in 2017 to step out into the independent space. And so that's what we do with Omnia. I run 11 different fund models. We're going to reduce that down to 10. But we've got conservative, moderate, aggressive equity. We got commodities, precious metals. We are in the crypto space as well, cannabis. So we offer a wide variety of different arenas, and hence need to track and follow a number of different asset classes and arenas. But our whole approach, we are not a buy and hold Wall Street investment firm. Actually, on our website, basically our motto is invest for growth, but more importantly, mitigate losses. If we do that, then returns take care of themselves. And what better alpha strategy than not take losses?
Oh, yes, quick question for Cory.
What's the strategy that you're getting rid of?
We're getting rid of the long short fund. It did great in March of 2020. It is just, I can't even find a nice word for it in how it's done in these central bank manipulated markets. But we are just waiting for, and my line of thinking is very much attuned. I've actually got some points to go over on some of the stuff that Jeff was mentioning to get into and back up some of the things he's saying. But ultimately, the long short is we are loaded up for that epic move. And so once we can get back to at least a break-even mark, then I'm getting rid of it. It's just too difficult to try and when you're purely investing for growth and then just moving to cash and avoiding the losses, it's a lot easier than trying to short things when things are being manipulated. I guess if that's succinct enough to answer.
Mark, you're on mute. Mark Heil, you're on mute.
Thank you. I'm having some technical difficulties. I appreciate you pointing that out, Tyson. Blake, would you do us the favor and introduce yourself? Tell us a little bit about Amera, and then we'll go over to Tyson.
Sure. Hi, I'm Blake Singer, and I'm not 7 foot tall. And
Come on, we're all
Trust me.
that's Zoom's a great equalizer. We're all 7
Trust
feet
me.
tall on here.
So I'm a managing director at Amera Securities, and Amera Securities is a kind of a very small broker dealer. We raise some capital on occasion for some healthcare companies, some ag tech companies, and since the head of the firm is based in Toronto, we have in the past done some natural resource companies. And so that's one hat that I wear. The other hat that I wear is I have a consultancy that provides alternative investment consulting to multifamily offices, registered investment advisors, and family offices. In the past, I actually got my start a couple blocks from here at One Bush in the mid '80s. In the '90s, I founded and ran a value-based equity investment firm. In the 2000s, we ran about $600 million in 2 different statistical arbitrage strategies. It was a very institutional portfolio or clients, and 1 volatility arbitrage. And we ran a trade finance fund that had operations in Brazil and South Africa, and then I consulted to a single family office in Portland, Oregon, before moving out to New York. So that's it.
Well, thank you. I appreciate that, Blake. And Tyson, I'm going to ask you to step in. By the way, is this better now?
Perfect.
Good. Excellent. So Tyson, I not only want you to start off and introduce yourself and tell us a little bit about your firm, but also then to lead us right into discussion. I know you have a couple slides that you'd like to show and go over with the group. It sort of builds on what Jeffrey was talking a few minutes ago. But also I'd like you to, maybe take the first crack at defining alpha strategies for us and what that is, and then, provide some historical data around what we're looking at today. So thank you.
Thank you, Mark. Thank you, Marty.
Thank you, everyone. I'm Tyson Halsey. I'm a chartered financial analyst. I've been in the investment business for about 40 years. I'm going to go through a presentation, but going back to Mark's question, what are alpha strategies? Technically, alpha is outperformance. And what I'm going to talk about is a strategy that I think is going to deliver outperformance relative to the S&P 500, which I think is typically how people define alpha. We're also talking alternatives, which is typically not stocks and bonds and everything else. So I'm going to just jump right into it. I'm going to share a screen here. Can everyone see that?
Yes.
Okay, so basically, I think that what I'm doing overlaps a lot with Jeff Hughes, but I come up with some different conclusions. I'm not nearly as bearish, and I'm not convinced that we are going into a deflationary cycle at all. But Marty asked for 3 slides. I don't count well, so I'll try to finish everything in 3 minutes. What I think right now, in terms of alternatives, in terms of significant outperformance, your best bet right now is investing in gold and precious metals. And the reason is that I believe that we are in an inflationary commodity cycle, and that is juxtaposed to a financial cycle, a deflationary cycle, and that is the golden age of stocks, bonds, and real estate of the last 40 years, where those asset classes have all done exceptionally well on the back of declining interest rates. And now that trend has reversed, and that is what I think lays the basis for an inflationary commodity cycle. So here is a chart that Jeffrey Gundlach published, and I thought was, and I've followed ever since. And basically, it's the CRB divided by the S&P 500. And from 1999 to 2008, you had a very nice move. It was about 700%. Basically, his conclusion is if you catch this trade correctly, you can really significantly improve your alpha. And during that period from 99 till 2008, oil prices went from about $20 per barrel to 200. The S&P was basically down slightly. We're coming off the bubble top. And then alternatively, we switched into a deflationary cycle, which I now think is over. And that was when oil prices and interest rates really dropped precipitously. Oil prices went from $160 down to $12, I guess, in 2020. And now I think that we are in an inflationary commodity cycle. And I love this quote, and you can never go wrong quoting somebody brilliant like Jesse Livermore. Patterns repeat because human nature hasn't changed for thousands of years. So I just showed one interpretation of why we're in a commodity cycle. This is why I think we're in an inflationary cycle. And again, this is cycles repeating. This is the S&P divided by the PPI, a log of that. And you may not see it that well. I'll see whether I can increase it for viewers. But I think going back about 140 years, what we definitely had was an inflationary cycle from 1971 to 1982. We had oil prices going way up, the stock market stunk. But then from 82 on, oil prices moderated, and stocks and bonds were off to the races for 2 decades. It peaked again in 2000, and actually oil prices were very cheap. They took off, as I mentioned before, from about 20 to 170 by 2007. And then we moved it, then we went to a deflationary cycle again, where stocks and particularly long duration assets did exceptionally well. The Qs, the S&Ps, tech, FANG stocks, you just couldn't go wrong. You had tremendous returns. I think that all started coming apart in 2000 when oil bottomed. And now I think that of the commodities and alternatives, you want to be in gold, in precious metals. So the quantitative case for gold, let me see, is that basically I've done some modeling in the past. Momentum is one of the top factors that, you know, portfolio managers use, asset allocators use, and gold is starting to break out, and momentum starts to score things higher and higher. It is also non-correlated to the major asset classes being stocks, bonds, and real estate. And it's my belief, and Jeremy Grantham said it quite well, both stocks, bonds, and real estate have gone 3 standard deviations above their trend lines, and they are now reverting to the mean. And so all that money, trillions of dollars, is looking for new places. So one of the things that I think is particularly attractive about gold is that currencies are, central bank behavior has been reprehensible if you're a conservative monetarist. And I think that basically confidence in currencies is really turning to hell. I'd have a sharper word, but I know I'm being recorded. And I think that gold historically is known as a store of value. It's fungible. I mean, they'll use that on the black market. And I think that it will come back into vogue. You're already seeing it being bought by central banks as an alternative to currencies, fiat currencies. And another case is that actually production of gold mining has begun declining, and reserves are very small. And I mentioned that central banks are buying gold. What you have here is a chart of actually gold producing countries' central banks. And there has been a meaningful pickup in their holdings of gold. And I think that's interesting because frankly, you would think they would just turn around and sell it. The central bank would not hold it. So that really suggests that you're going to see more central bank purchases of gold. And basically, if you aren't familiar with the asset class, here is a long-term chart. And from the 70s till 1980, gold went from 35 to 700 or 677. It's an unfair comp because basically it was regulated and held at 35. But then again, during that deflationary environment from 1980 to 2000, gold did not perform, stocks did great. But then again, things flipped. And from 2000 to 2011, gold took off. And that was one of the commodity cycles. And then it's really been flat until recently, and now it is taking off. But what you see is huge runs in gold, and that's what I think is headed for us going forward. That's a little about me. I think my claim to fame is winning the USA Today CNBC National Investment Challenge. And I was up 1,078% in a quarter trading biotech options. I have some derivatives in my background. Anyway, Mark, I'm not sure I answered your questions, and I'm glad to do that if I fell short.
And
No, I
Mark,
think you did.
Mark, there's a question in the audience from Marty.
Sure, fire away.
So Tyson, when you talk about gold, you talk about physical gold or paper gold?
Actually, both, but actually I prefer to own gold stocks. They tend to be more levered, and they're really good values. And you can get companies with decent dividends, and you get a lot of operating leverage. But you know, as gold goes, the gold stocks will probably go up multiples.
By gold stocks, does he mean miners, or does he mean
gold miners?
paper gold?
Gold
So-
miners.
Gold miners.
Gold miners.
I would own the GLD, which owns the actual asset. But I also am partial to like the GDX, but you know, I own GOLD, which is is Barrick Gold, very conservative, about a 3.5% dividend. But also Sabine Stillwater, they got about a 7% dividend. It's at risk, but they've got a lot of other. They have high platinum and gold reserves on a per share basis, some of the highest. And they're getting into some of the green metals as well. But I think it's a very cyclical call. I think these stocks are due to run. And well, I don't agree with Jeff Huge's serious, deep end of the world kind of decline. I really think that if you're putting money, I think a lot of people will want to be putting money into gold. And right now, I think the reasons to own it are excellent. And so it'll be where you get alpha.
Does Tyson have any thoughts on, things like fracking and new technology applied to gold mines, like prior gold mines, any thoughts like that?
Don't know
Tyson,
a
what are your
thing about
thoughts?
it.
Can you hear the question, Tyson?
Yes, and I don't know anything about fracking gold.
Yeah, I know some gold miners in South America, and they're all revisiting old mines because technology has improved so dramatically to be able to extract gold. It's a thing,
Well, we can talk about that later.
right? And there's a guy in Boston, there's a Harvard guy he's fracking old Japanese gold mines. And he's like a
What
famous
do you
guy.
mean fracking? Putting water in under pressure?
You can apply new techniques of mining to gold mines that weren't available. Some of these Japanese gold mines have been shut down 50, 60, 70 years. And what's this guy's name? I'll get it in by the time we're finished.
Yeah, Marty, and Wire Gold, remember the second most famous person, Rob Colorina, next to you? They're doing the tailings. They'll take a big old tailing pile and reprocess it. They think they get a higher yield. So that's all I know, but I don't know the technology.
It would seem to make some sense, wouldn't it? That you could apply these new mining techniques to get some more out of these mines that exist. I guess, the question is how much is in there, how costly is it, and how much sense does it make to do that? And there are people looking at those bets who are a lot more intelligent than me on this subject matter. But
Hey, Mark, real quick, whatever you
Yep.
did before with your audio worked great. You're back.
The headset's
back to
garbled.
garbled. I'm just going to take them off.
Put more quarters in the.
Our quarters in there.
Yes.
So what I want to do now is maybe have Cory just take a minute. And Tyson gave a definition of just outperformance. Are there some other characteristics you would associate with alpha strategies?
Well, I mean, generating alpha is the the definition of that is outperforming, right?
Well, I mean,
so I don't know that there's anything to add to the definition of it per se, but maybe areas of where there's potential better growth opportunities or better outperformance.
Sure.
And so given actually, you know what, I have a screen share capability. Yeah. So just to look at a couple of areas, and knowing that actually. Which screen are you seeing? Are you seeing a screen come up?
We
Yes,
get
I
the
am.
real S&P 500.
Yep. All right, perfect. I don't know what that's. So, Jeff mentioned that we could be in a period where it could be 17 years to a new high on the S&P. What this chart shows, it's the S&P 500, but it's the real S&P 500 index, which is adjusted for inflation. So you take the nominal price adjusted for inflation, you look at the peak. So this was 1929 right here. That was the 29 crash. You had the 30s global depression. But look, there was a 29-year period before the S&P recaptured its high. Going back to early 1900, there was 26 years from peak to trough and back again. He also mentioned from the 60s through the 70s. That's a 23-year period. And then even from the dot-com bubble up to 2014, 2016, that was a 14-year period to recapture those true, real all-time highs. So, when he talks about 17 years from where we've been to recapture or go to a new high, you now see in graphical format that is absolutely and historically has been done before, or we've had periods like that before that we've gone through, at least on and Marty, you asked if that accounted for inflation. Well, that's exactly what this chart does. It accounts for inflation. But and also remember, for anyone out there that is thinking about as their allocations and waiting for an announcement of a recession before they think, oh, now's the time to sell, just remember that the NBER, on average, by the time they announce that we're in a recession, on average, I believe it's anywhere between 8 to 14 months after the recession actually began when the announcement comes. So that's never a good approach to making decisions on your investments and such. Now, as far as deeper declines, I've been saying since 2018, even on my updates, I've been looking at ultimately we could see a return to the 1800 to 2000 range. And I think, Jeff mentioned we could even go down as low as, around the 1000 area. But, moving forward, where are some areas of opportunity? So looking at, well, and actually, I don't know if this is, so this is on all the funds that we run, we build out the fund models with ETFs as the underlying investment vehicles. So this is the TLT, long-term treasury bond ETF. It dropped from 180 down to 90. It lost half of its value from March of 2020 through the end of last year. So looking at these sorts of moves, and that's why your average 60-40 portfolio had its worst year on record last year because of this massive drop in the actual capital price of bonds as yields took up. Interest rates and bond prices, or yields and bond prices up, are diametrically opposed. As yields go up, bond prices drop, obviously. So that's what I'm trying to get to. But now you have a great opportunity in the fixed income space. As far as how we do things, looking at the wrong one. As I mentioned early on, the best way to generate alpha is to not get hit with losses. So on our conservative, 50-50 fund model, during this period, if we're half in fixed income, but we are not buy and hold. So even though bonds themselves during this period got absolutely crushed, the half of our fund that is in fixed income did not, because we were in cash and we were avoiding those losses. So, head to head since inception, our conservative fund is beating your broad US markets by 15.5% because we're avoiding those losses. You look at our US equity fund head to head, we're outperforming by 30% because we protected from 2018 crash, the 2020 crash, and the downturn. We've actually made money in our US equity fund while US markets have been declining. So that's what I mean by saying, the best alpha strategy is to not incur the losses. If you're avoiding losses while everything else is dropping, you're automatically generating alpha because you're automatically outperforming. But from where we stand today, I'm big on, we had the dollar take off to all-time highs. Since that's been turning around declining, guess what? Emerging markets got absolutely crushed, and China and the Asia Pacific region, they've been turning around and taking off. We've been heavily invested in the emerging market, China, Asia areas on our international fund. I think fixed income is some great opportunity where it is right now to get into. Getting into the more esoteric areas, I'm very bullish on gold in our precious metals fund. It's not just gold and silver, but it's gold and silver miners and then gold and silver junior miners as a full compilation. And as Tyson was saying, as the price of gold goes up, then the profitability of those mining companies goes up exponentially. So it is a multiplier effect. But then not just that, I mentioned we're using the ETFs as the allocation. We're actually using leverage. So we have 2 times and 3 times levered miners and junior miners and allocation for, UGLD for the pure gold. So overall, we're doing the precious metals area with leverage. I'm very bullish on that arena. Commodities, I think we're going to have continued upside in commodities as we move forward. We run a commodities fund. Cannabis is one of the other funds we run, and that one, it's just been a dog. It's been a downward dog, and it's hard to make money in a declining asset class. But I think with cannabis, it's going to be more of, at some point, we're seeing all the states and cities around the country, continually approving marijuana, but I don't think there'll be a major catalyst for cannabis until we actually get federal legalization, because at that point, you have all the big alcohol, tobacco, and pharmaceutical companies are going to come in and buy up all the mom and pop shops. That said, markets are stated to be forward-looking. So, buy the rumor, sell the news. So on anticipation or even momentum and money flows coming in, cannabis is at very depressed levels right now. So think about buying when there's blood in the streets. for a longer term play. And then ultimately the crypto space. We run both a Bitcoin and an Ethereum fund. And I think those both washed out. We're seeing a nice, foundation basing that's been going on here lately. We are fully well, I'll tell you. So we're fully invested in our conservative, our global, our moderate global opportunity, our international, crypto, Ethereum, precious metals, and we're back in cannabis, and our commodities is half allocated. We're in the rare earth area and the uranium and uranium miners in the commodities fund. The food stocks and agriculture and such, they had a good run, but we're currently in cash on those. And then our US equity fund, we are very light. Just a couple of small tactical positions there, but all those other arenas have a lot more upside than US equities for various and differing reasons.
We have 2 questions from the audience.
Sure.
So Gary Zaka, we've been on your panels before. I want to give you guys both credit because, I've listened to you real closely. And last year I did pretty good in the market, in part because I had a 60-40 portfolio. But in my case, it was 60% short, pretty much short anything that had listed options, either, that I sold the options. And then the other 40% was things like commodities, some gold, which kept, selling options against them, call it weight, and some, big pharma or whatever. So, I would say listen to you guys because the party line is that, everything's going to be great, as long as you did exactly the opposite of Donald Trump. So I think that you guys, listen to you guys, you have a diversity of views. Some of them are a little esoteric for the ordinary investor, but certainly these are really good words of wisdom and, help me a lot.
Party?
Yeah, Cory, isn't cannabis overcapacity? I mean, if you bring federalism, a lot of markets will crumble. A lot of the states will crumble if you allow trade across states.
But the reason why alcohol, tobacco, and pharmaceutical companies are not in the cannabis space so far is because we have disparities from state to state, and they've got all the interstate commerce rules and regulations. And so, until they actually get federal legalization, they're not going to enter the space. So, think about all the applications in those 3 big industries for the cannabis arena, and the rationale and reason why they would want to go out and gobble up all the mom and pop shops. So as far as a catalyst for upside momentum in that arena would be all the M&A that's going to go on in that arena. Not to mention, everything goes through cycles. Nothing goes up forever and nothing goes down forever. And if you look back on a historical chart, just looking at, given where things are right now, there's that share. So looking at one of the cannabis ETFs, right down here, and see it's sort of forming this foundation, this baseline right here. Could it decline further? Sure, it could, but it's really been holding on here for the last year almost, or at least 9 months here. But looking back, it's it's currently trading about $4 a share. It was over 32, maybe 34 at the high, 32 at the high. But prior to that, it was as low as $6 a share. And then before that, it was at 26. So these are some massive multi-100% moves of performance or decline in either direction. So even though there are concepts of and there's a lot of private equity that have lost a ton of money in the cannabis space because they went into overproduction and flooded the markets and there just wasn't enough demand to soak up everything. Not to mention, I mean, the illegal cannabis market's still a problem, and because there are high taxes on the states that do have legalized cannabis, but there's still a huge market in the illegal arena where they can undercut and sell at a cheaper price. But still, you just see, looking at this, to me, this is a massive value play right here compared to where its previous cyclical moves have been twice before. So you come from $4, you go back anywhere near 32. What is that? About 700% of potential upside. But the issue is, what's the catalyst that's going to drive it on that next move higher? Sometimes it's just pure investor sentiment. Everyone starts to get bullish and say, oh, hey, we're going to start moving towards federal legalization, and everyone buys the rumor. So they start buying before the actual announcement of legalization or anything that occurs. So I'm just saying, from a tactical standpoint,
Great.
yeah, you go from $4 to $2. That's still a 50% loss if it does decline and go down. But overall, like I said, the catalyst for that arena is really moving towards federal legalization, which opens up a lot of M&A and a lot of buyouts, which would be an upward inflection for all those prices.
Well, thank you, Cory, for that. Just quickly, Cory, as you went through everything, I was looking at the top 10 performing ETFs of last year. And the first one was an emerging market fund solely focused on Turkey. The second one was something that was a hedge fund betting against the interest rates. And then the next 8 were all focused on the energy field, including, and it was interesting to me, some of them were only focused on oil and gas, but none of them were solely focused on green tech. So I want to get your reactions to that and maybe to talk about the energy space a little bit.
Well, I mean, there's a lot of move away from the whole ESG arena that I'm seeing in various markets and various institutions and such. As far as Turkey is, their inflation's out of control over there, and I've been seeing that, and so I don't know if that Turkey focused fund, was that a US denominated?
Yeah, it was a BlackRock fund.
Yes, I mean, you've got, you have these anomalous one-off, places that, even within the broader frontier market or emerging markets that can have outperformance. But you know what? I mean, truth be told, if the dollar, when did the dollar start turning? No, I don't want to share. Stop that. Yeah, so the dollar peaked in September of last year, and then it started declining. So you had that 3-month period, October, November, December, of upside performance, because the broader emerging market fund, EEM, it bottomed, in October. And so it was up from a low of 34 and finished the year. Well, it's up now to 40, 41. So yeah, with US markets down 23% and emerging markets turning around late in the year, then maybe you saw some, but then again, we are looking at full year performance. So I did not.
Yeah.
Do you have the ticker on that fund?
It's the BlackRock iShares MSCI.
Well,
I don't want to get too tied up on that. I was
No.
more or less thinking more along the energy lines, and what's going to happen in energy. Where do you think it's going to go? Is this potentially an alpha play, or is this already run its course and it's no longer there? And then also the green tech.
Well, I mean, as far as oil and the energy arena, I'm seeing a lot of charts come out and things with expectations for much higher oil prices moving forward. And you come back to some of the geopolitical stuff that Jeff was talking about. Look at the China's Belt and Road Initiative and their tie-ins with Russia, and they're trading and buying Russian oil and then turning around and selling it elsewhere in renminbi. And then with the moving forward with the convertibility back to gold. I mean, and this isn't me. This is coming from Zoltan Pozar. He put out a great article month and a half ago where he was talking about, really they're setting up a de facto pricing of oil in gold because of this dynamic that from Russia to China and onward sales and such. So, and also you've got the whole Belt and Road. You got China and also the global South with Africa and some of the emerging markets moving away from reliance on the US dollar and setting up their own currency backdrops. And so, as the dollar starts to drop out further, then anything denominated in dollars will rise in sympathy. So you've got the commodities, you've got the energy sector, you've got, there are multiple factors that are in that space, but I think energy is higher moving forward.
Got it. Hey, Blake, I remember last summer you were on one of our panels, or actually it was you and your partner, and you spoke about a strategy of selling coal to Europe, which obviously was aimed at this winter and the shortages they may face.
What was the
Wondering what your
strategy?
thoughts are on the energy space.
You know, I guess my thoughts on the energy space reflect my thoughts on trying to predict anything, which is it's incredibly tough. And so, you know, as I've mentioned before in previous conferences, I'm a big believer in uranium as it's not a green solution, but it's a clean solution to our energy problem. But, you know, when it comes to trying to predict interest rates or what the market's going to do, and you know, the thesis of this is alpha, and I'll take a different approach to it a little bit. Alpha is really the outperformance or underperformance relative to a market. I don't believe alpha, and one is generating alpha if they accurately predict a market. Let's say the market goes down, and they accurately guess that they're out of the market. That's really market timing. So I would define alpha as the ability to, stay within a market, outperforming, underperforming. I'll give you an example. In the late 90s, I ran a value strategy, and the high tech was going through the roof, and we looked like absolute dopes, complete dopes. And then when the market turned, a lot of the pharmaceutical stocks that we had and a lot of the value stocks did great. Were we any smarter? No. We just happened to be on the wrong side or the right side of a particular market move. So as opposed to, let's say, an arbitrage strategy that might or might not be able to produce returns in any type of market. Alpha is really, really tough to come by. And this is not going to really answer your question in terms of energy. But I go back to it in that, I have no idea. I mean, it's trying to predict. My dad always used to say, if you're going to predict often. And so, we look for businesses. We look for businesses with moats around them that happen to be alternative investments. So, we just funded a fund that invests in farmland, and it's a small fund, $150 million fund. And they go out and buy commodity farmland that is winter wheat in southern Washington state. And it's cheap. It's not a lot of yield. And farmland is really like commercial real estate. What they do is they then go in, convert it to organic, and convert the winter wheat into wine grapes or blueberries or other high values. So they really add value to that underlying farmland. And they have a big water rights play, which I won't go into. So that's not comparing farmland to the farmland index. That's not comparing farmland to real estate as an index or having alpha. That's just a business that generates, really, really smart returns. That's value add. And so I guess we look at it a little bit differently, if that makes any sense, Mark.
Yeah, and you play more in the private equity space than the public space, correct?
Not necessarily. I mean, I think, Izzy Englander's Millennium Fund has incredible alpha, and he's got an enormous moat around his business. And at $50 billion, he was up, I think, 12% last year. It's amazing that he continues to create the returns that he does. But I would contend that it would be darn near impossible to recreate Millennium Investment Firm today, starting from anew. So he's created a heck of a moat around his business.
Gotcha. So you look for opportunities like that, and you're currently your business is an outsourced CIO for family offices and for foundations and the like. And I one of the things I wanted to just bring on up was the conversation we had the other day when we spoke, and you brought up the concept of beta to us. And, everybody understands that beta is the measure of volatility compared to the market. So I wanted to get your thoughts, if you would. Yeah, as an outsourced CFO or CIO, how are you using the concept of beta to help generate alpha returns?
I mean, let me just jump in. Mark, we've got about 5 minutes left. So just
Okay.
so you know, also there's some questions in the Q&A when I get to. So Blake.
I hear the Academy Awards music starting. So beta and alpha, they're backward-looking measures, right? So beta is what the market did. Alpha is in a high beta stock or low beta stock. Those are backward-looking measures. They're not generally, they can be, but they're not very predictive of what might be going forward. And a good example is General Electric. For years, General Electric had the most reliable, stable earnings of any company in the United States. And it was just one quarter after quarter after quarter. And after the, in the mid 2000s, the growing influence of GE credit on the company completely changed their business. And so they went from a very low beta, put in your grandmother's account stock to an incredibly high flying financial services nightmare. And so just by looking statistically backward at what an asset class or what a stock has done, either being volatile, low beta, or highly volatile, high beta, is really not that predictive in my mind of its future. So I don't really look at it.
Gotcha. Now, in every bad market we've ever had, good companies have emerged. We have, back from the 1980s, we have Microsoft and Apple that came up. 2000s, you have Google and Amazon. 2008, you have Uber coming out of that. As you sit here and you look at these markets and you're thinking about investment strategies to achieve alpha, there are still going to be some good companies that come out, whether it's consumer, whether it's in real estate, whether it's in healthcare. Maybe just sort of think about each of those areas and talk about what excites you within healthcare, within real estate, and what, conversely, what turns you off, or maybe you're just avoiding the asset class altogether.
No, I think oftentimes money is really made in the equity markets when there are dislocations. And I would, while not as dire as the first presenter, I think that, the market's expensive and there are going to be some very inexpensive opportunities down the road. Where they appear, it remains to be seen. Oftentimes, the areas of the market that get hit the most tend to create some interesting opportunities. And I guess looking forward, I would say that given the amount of credit out there, given the amount of private equity lending, there's going to be some interesting opportunities in the banking system. Again, once they go through a little bit of bloodletting. And I think there's going to be some interesting opportunities in the insurance business as rates go up. But for me, it would really be waiting to see what gets hit, what valuations arise, rather than trying to predict what's going to do well. I'm not a good value guy. I'm not a good growth investor. I'm more of a value bottom picker.
Well, you look for places that have moats around them, and oftentimes they generate good returns.
Yeah.
Marty, what I'm going to do here is if you could read me the questions or ask the questions you want to go through before we wrap this up, I'd appreciate you jumping in.
Yeah, Marty's left, but I'll just, if there's any questions in the room, and if not, we can just, I know he's got another presentation coming up. So I don't know, any questions in the room?
Okay, well, he gave me the 5 minute.
I wanted,
Oh,
Mark,
I don't have a computer in front of me, so I can't see the questions from the audience.
Mark,
Yes.
you asked a question that I wanted to answer that you had directed to Cory, and basically, I actually think that oil prices could go a good bit higher, and that clearly there is significant demand in the mining area for these green metals, nickel, cobalt, lithium, and copper. And I think that one of the interesting things actually about gold is that one of the reasons it's capacity constrained is a lot of mining companies have shifted away from gold into these. I think this is a huge market, and I think that that's where people want to be investing going forward. And I was talking to one strategist today who was saying that in Russia, the resulting decline in the exports of their oil inventories has led to a significant deterioration in their infrastructure, which will take a long time for them to rebuild. So I think I think that there's a chance to be bullish on oil, and oil could get back to 110, 120, and maybe even higher. I think there's a chance that China will be strong and will have a stronger economy, and that we actually may not even have a recession. And to that point, there was a economist from Duke who had developed the yield curve signal, who was on CNBC yesterday saying that he had developed it. It's always been right, but this time he actually thought it might be wrong and was going against his model. So I think the real surprise that we're looking at in the economy is that there was so much COVID money, and balance sheets of banks were repaired after 2008, that while we've had a huge ratcheting up of interest rates, it hasn't had the bite because there was a lot of slack to absorb it. And so if we actually get China back in line, maybe some end to this Ukraine war, we might actually be surprised. We'll have a modest slowdown here, some earnings recession, but there's a possibility that it may not be that bad. Nevertheless, I still like commodities and gold.
Fair enough. Cory, did you want to respond?
Yeah, quick counterpoint to that. With all the COVID money and everything else, looking at revolving credit card debt, over the years, it's been on this big rise. There was a big drop as people got their COVID money, paid off debt. Guess where credit card debt is now? Bigger and badder than it ever was before. People are living on their credit cards, trying to support their families, their households with their basic needs and bills, living on debt. And then add on all the layoffs that we've already been seeing, and the backward looking employment numbers, as Jeffrey was talking to, is that there's still, and not to mention the rate of interest rate increases. It's been the fastest rate of change on interest rate hikes since back in the 70s. That still hasn't fed through the real economy yet. We've still got to feel the knock-on effects from all that. So I'm in Jeff Hughes' camp, as we've talked about before.
That's what makes
so guys, let me just intervene here. So I mean, and just getting back to what Cory's saying, there has to be some kind of linkage between Main Street economics and the central banks, right? Because if you look at housing prices that have just gone through the roof, and the same kind of mortgages that were available in 2008 have been deployed post 2018, let's say, and so we're kind of in the same bind with housing, with mortgages again. And I don't think there's going to be another wave of foreclosures like there was. I mean, 5 million people were foreclosed on post 2008. I don't think it's going to happen again. It's not, politically, a political solution is to foreclose on people again. So, I don't know what the connectivity is. There's a lot of people smarter than me. Central banks seem to have their own mind about what they're going to do. So, intriguing times. Blake, did you have any comments you wanted to make? I mean, let me just give a couple of alternative investments. I think so I'm seeing a lot of people rolling up dental practices. It's like a big thing, right? So private equity firms are buying up dental practices. People are getting older, their teeth are getting worse. That's the logic, right? Couple other things. I still think credit matters. I think roll-ups of businesses that people bought, baby boomers bought, a huge wave of baby boomers are retiring. So anything that's linked to this baby boom retirement wave, a lot of people became Kinko's franchise owners, like franchise roll-ups. I think that's going to be a big thing. And again, I'm still big on secondaries, distressed owners, things like that. But Blake, why don't you?
Yeah, I know, Marty. You and I have talked about distressed, and I think that while we may have a little stress in the system, we haven't gotten to distressed yet, and it's very difficult to invest in a distressed manager in March of 2009. You have to kind of get in before. So if you are allocating capital, a distressed area is a great place to look. The other area that I really like is any type of affordable housing. And I've seen not having invested any of them, but there's a lot of modular housing that's coming out that's very interesting. We've invested in mobile home parks for a long time. The cap rates are getting pretty spendy right now, so I wouldn't put a lot of capital there, but they've been fantastic investments. So anytime there is, and one last other thing is that there have been a number of private equity real estate firms that are doing conversions of, garden style, mid-90s apartment complexes, upgrading them, and that's been an intelligent core plus strategy. You had one question from the audience?
Self-storage.
Self-storage is the other one. Self-storage and mobile home parks go perfectly together.
And so the two things, so they're not building any mobile home parks anymore, right? And the thing about self-storage is that cities hate them. And the reason why cities hate them is because you can have a self-storage building, which is the size of a massive apartment complex, and there's only 2 employees. So it doesn't create income taxes, but they are fantastic as a long-term investment. It's a heavily fragmented space, and depending on where you are located, it works out pretty well. So I know I had a couple other ones that were out there, but again, I think alternative housing fabrication is a big one. Reshoring manufacturing is going to be big. People get into that. Anybody who has linkage, I think alternative credit for military and military venture capital. So like Department of Defense, In-Q-Tel is a huge,
Yeah.
is a huge funder of private equity. Max, you have a question?
Also, I think a lot of people like to pan the housing sector in the Bay Area. First of all, I think nationwide, but specifically here, it's always going to be a good investment. And people like to say negative things about rent control. Rent control has a lot of nuances, and if you understand it, it's actually, it's not really a huge negative. So if you're looking for, managers who know how to navigate that, that becomes a competitive advantage for them. And it's actually, I think it's very attractive.
Workforce housing, another one that's a big macro one. Any others? Tyson, you want to spitball some? Cory, and anything else? 30 seconds or less.
I know you talk about reshoring and nearshoring. I've seen a lot of stuff about Mexico being, as far as nearshoring and relocating a lot of our supply chains back from the eastern part of the hemisphere to more localized. So, that could be an additional play within the emerging market space, but benefiting from the reshoring of U.S. industry.
Tyson?
And this is a real situation. We're looking at buying, looking at a package of natural gas properties in the Haynesville, about $100 million. And the reason is natural gas prices have fallen off. It is the cleanest of fossil fuels. We've already seen that fossil fuels really can't just be written off. There's a lot of demand. Natural gas is the cleanest. The Haynesville is very attractive because it's close to LNG production, which allows us to export our cheap natural gas. And we're looking to do some things to clean up the leakage with Bate so that they're much more environmentally clean. But the returns are actually very attractive, and that's very consistent with my inflationary commodity assessment of where you want to be. You don't want to
and getting back to Bate, there's a schism between impact investing and ESG. People are telling me that ESG is what they do in public equities and impact is what they do in private equities. I'm not sure what the definition is, but I'm gonna love to hear Tyson talk about that tomorrow. So it should be great. So one last comment. Gudrun mentioned something called XBI Biotech. I have no idea what that is. Does anybody here know what XBI Biotech is?
NASDAQ Biology Index.
Not NASDAQ Biology Index. Okay. Biopharma. Any thought? Is that a buy, a sell, a hold? Any thoughts?
Yeah. I hear it's been decimated, so it may be attractive.